It doesn't matter if someone's a company or individual, a politician or an investor. Inflation is a serious concern for everyone. From buying groceries to gasoline to automobiles, inflation has hammered Americans' purchasing power. In fact, the most well-known metric of inflation has soared to a 4-decade high. A myriad of factors has come together to increase inflation in 2022 and 2023. To remain financially healthy, it's everyone's wish to invest one's money in a way that at least keeps pace with inflation and generates profit, too. And yes, there are many investors who have exceptional records of making money even during high inflation times. Berkshire Hathaway CEO Warren Buffett is one of these investors. So in this video, we will discuss Buffett's strategy to invest money during high inflation times. Let's start with the cash. Cash is considered to be the worst investment during inflation.
Well, cash is always a bad investment. I mean, when people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time. And then you always want to be sure you have enough.
Warren Buffett's not the only investor who thinks holding cash is a bad idea during inflation. His fellow billionaire Ray Dalio has shared the same views with an attractive quote: "Cash is trash."
And the issue is you can't jump into cash. Cash is trash, okay? Cash is that they're going to, because they're going to print money. What do? You get out.
This is because cash depreciates during inflation. Being an investor, one of the major things is to think about investment returns. It's referred to as the philosophy behind calculating return on investment. It's pretty simple. For instance, your investment gets you a 10% return annually. It's great, right? But hold on. It relies on the rate of inflation. To get the real rate of return on investment, you need to calculate the inflation impact and then subtract it. If inflation is 7% and investment return is 10%, well, then your real return turns out to be 3% only. This doesn't remain exciting anymore. This is why we see that cash is at the bottom of this hierarchy. The reason is that returns on holding cash is zero. Hence, holding onto the cash for a longer time period enables inflation to work against you. So after cash, there are treasury bonds. According to conventional investing wisdom, bonds are considered to be one of the safest investments. However, they're not. Buffett argues that bonds are not that safe when you look at them related to inflation impact. Let's explain this point. To the date this video was made, the yield on a 10 years US bond was 1.8%. Therefore, if you purchase a 10-year bond, you'll be locking in a 1.8% annual return for the next 10 years. Now, we assume that inflation averages 4% over the upcoming decade. Thus, you'll be having an annual return of negative 2.2% after the inflation impact. Listen to what Buffett has to say.
You know, if we dropped $1 million of cash into every household in the United States today, everybody would feel very good, except the people that invested in things that were denominated in dollars. And, yeah.
Once again, those who possess fixed-rate debt, such as government bonds, remain at a loss during inflation as compared to the ones that borrowed money in the long run at a fixed rate. For instance, these people used mortgages to buy property. Let's take another example. I bought a home in December of 2020. This allowed me to lock in a mortgage at a fixed rate of 2.8% for 30 years. This implies that interest rates as well as mortgage payments will be fixed for 30 years. This is the ideal place to be during inflation. However, inflation eats away the mortgage debt value with every passing month and year. This is because inflation devalues each dollar. Mortgage debt is paid with devalued dollars.
If you own a home, though, with a very large mortgage and you have incredible inflation, it wipes out the mortgage, and you've still got the home. I mean, in
Weimar, Germany, they gave you the mortgage back at the end. Well, it's very interesting. That's the one thing they did right.
Next in the hierarchy are precious metals, such as silver and gold. Buffett names them as unproductive assets. Now, these assets are not very bad to own during the inflation period. Theoretically, these assets can at least keep up with inflation. However, these assets don't enhance the owner's purchasing power.
I will say this about gold. If you took all of the gold in the world, it would roughly make a cube 67 feet on a side. So if you took all the gold in the world, we could have a cube that went down there 67 feet, 67 feet high, and that would be the whole thing. Now, for that same cube of gold, it would be worth at today's market prices about $7 trillion. That's probably about a third of the value of all the stocks in the United States. So you could have a choice of owning a third of all the stocks in the United States, or you could have a choice of owning that little block of gold, which can't do anything but kind of shine there and make you feel like Midas or Croesus or something of the sort. Now, for $7 trillion, there are roughly 1 billion acres of farmland in the United States. They're valued at about $2.5 trillion. It's about half the continental United States is farmland. You could have all of the farmland in the United States. You could have about 7 Exxon Mobils, and you could have $1 trillion of walking around money. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, maybe touching it, fondling it occasionally, and then saying, do something for me, and it says, I don't do anything, I just stand here and look pretty. And the alternative to that was to have all the farmland in the country, everything, cotton, corn, soybeans, 7 Exxon Mobils, just think of that, and $1 trillion of walking around money. Maybe call me crazy, but I'll take the farmland and the Exxon Mobils.
Being an investor, we don't want assets to just keep going up with inflation, but rather to own the investments which outperform the scenario of inflation, producing the real return.